Skylar, we just got off with Holly. It was a lot of fun. Holly's got a lot of great insights into the M&A side of the business world.
Yeah, absolutely. Definitely an interesting space. Obviously, you and I both been in the space in the financial services industry, and just hearing kind of from boots on the ground what people are doing both on the buyer and seller side, and how these deals are put together, and what to look out for as far as roadblocks, obstacles, things that happen, and what she's seeing in real time. So very fascinating.
Yeah, these are a lot of these. She gave a lot of really good stories too, where
Yeah,
it's something anybody selling a business, whether it's a HVAC business or a law firm, an accounting firm. It's just like there's those little things. Like she brought up the good point about like bad debt, where it's
yeah,
like somebody like you would have never thought about including something about that in a contract.
yeah.
So it's you really need. I mean, do your research obviously, but also probably be smart to hire somebody like Holly or somebody in the industry to really help out as you're putting a business deal together.
Yeah, definitely. It's definitely a team sport, as she mentioned. You need a good advisors around you to kind of help with the process, right?
Yeah, because I mean, you walk into a room with the private equity folks, and there's 10, 15 people. They're smart as hell. This is their 50th acquisition, and you're
They're
just doing
prepared.
it. Yeah. They're
You
prepared.
better be as well, right?
Exactly. So,
Yeah,
but yeah,
awesome.
fun episode. Without further ado, let's jump into it. Thanks for tuning into the All Funds Network podcast. My name is Mike Schroeder. Today we're here with my partner, Skylar Steinke, and we're at Holly Moeini. Holly is a CFO, CPA, and M&A advisor who helps buyers and sellers strengthen their companies, reduce risk, and maximize value at every stage of the deal. Holly, thanks so much for joining us today.
Thank you for having me on your podcast. I'm so happy to be here and talk to your audience, you and the audience.
Absolutely.
Awesome.
Well, yeah, thanks for the time. We'll maybe let's kick it off. Let's just start with your background. Kind of, take us through your background. I know you got the CPA. We'll definitely talk about that a little bit, and then kind of how you got into the M&A space.
Yeah, so I spent over 3 decades, don't do the math on that, but 3 decades as a CPA, started in audit, and then I took my career through as an executive. So I started buying and building companies through being an executive, part of our strategic plan of growing the company. And so I've implemented systems, I've helped run operations, I've helped run IT, and then I started getting into M&A. And I had an investment banker on the board that actually taught me how to do it right. And from there, I actually hung up my shingle and said, okay, I think we have a problem in the marketplace. So I was working in companies about the size of, I started about 30 million and maybe I took them up to 200 million. So I had done some scaling before and worked at companies that were a little bit more than mid-size. So what's happening in the marketplace and what I see is that of all of our small businesses, like we have 35 million, right? Of them, only 1% of them actually get beyond $1 million in revenue. Only 7%, sorry, 7%. And so like that's a bad statistic. And then when you look at the longevity of these businesses, they turn over and close their shop, 50% of them in 5 years. And then in 7 years, it's 75%. So our small businesses aren't doing well. And when we look in the M&A market, last year, I think there was close to 10,000 businesses sold. And most of them are small businesses. And 20 to 30% of the businesses that were actually out there sold. And that means that 70 to 80% of the businesses aren't even selling. And when you look at the statistics, nobody's getting ready. And there's $4 trillion in private equity out there waiting to be deployed. So that's like a really awful, these are not good statistics for our small businesses. And then when you look on the buying side, so you have this huge wealth transfer of boomers trying to retire. And then you have our young people that are coming in trying to buy. And we have a terrible statistic for them as well. 70 to 90% aren't realizing the value they thought they were going to realize in a deal. So, guys, what's going on here? There's a lot going on in this marketplace that needs to be helped. So, there's some myths. We'll start with those myths. And this is what drove me into this market because I was like, people need help growing their business, figuring out how to scale, and they definitely need help in the M&A market, both on the buy side and the sell side. So there's some myths. So the first myth is that our CPA is going to help us maximize our value. Your CPA helps you maximize your tax savings. That's what they do. Your books are designed for taxes in this small to mid market. And then the other myth is that if I ask your audience, the business owners, how many of you know your numbers, most of them are going to say yeah and hold up their hand. But what that means, and I've tested this, is that they know their P&L. Nobody looks at the balance sheet, yet the balance sheet is what houses your story of your financial statements. And if your balance sheet is wrong, your profit and loss is wrong. So that means you really actually don't know your numbers. And I have been in a room of 600 founders, CEOs. They all raise their hands for P&L. None of them raise their hands from the balance sheet. So the balance sheet tells a really good story that you have to be able to look at and analyze. So that's myth two. And then myth three is that I don't have to prepare for exit until I get ready for exit, right? And that's not true. Actually, everybody should be prepared for exit now. And what happens when you prepare for exit is that your business becomes more and more valuable. You think you're going to sell on blood, sweat, and tears and how much hours you put into it. It doesn't translate in the marketplace. So being exit ready is really important. So, and then for my buyers, they what you don't know. And M&A is complex. It's emotional. Nobody talks about that. I do because everybody gets excited and they stop thinking about some things that are really important, right? It's hard to find a good acquisition target. You just, both ways, or a good buyer. So it's emotional, it's people, it's human, it's legal, and it's financial. And so if you don't understand the full terrain before you get in on the journey, you're missing millions, you're asking for regret, you're shifting the the balance of structure and power. So that's why I wrote the book. And that's how I got into it. So that was a long route to get to your question, but hopefully I answered your question with a little bit of foundation about, like, it's a little messy out there right now. So I want to do my best to make it less messy and make people get the value that they should get, have their legacy continue on, providing great value for the buyer, and that was my whole goal for my book.
Yeah. So kind of stepping back to what you were mentioning earlier, Holly, some interesting statistics, and obviously your backstory is really fascinating from my side too, being in the space. You mentioned about being exit ready. So how does that, what do you see business owners doing? Obviously thinking about the end in mind, right? To your point, not in future state, but they should be working on it now. What does that look like, and what are they doing? What's your recommendations there?
Yeah, so let's talk about what they're not doing. And what they're not
Yeah.
doing is anything to get ready. So what I see a lot on my buy side is so a buyer will ask for the financial statements. So they'll give tax returns, which is the absolute worst thing to do. Now, you do end up giving tax returns when you're in diligence down the line, but when we are courting, you don't give tax returns. That's not your best picture because you're reducing your income to. So I see that, or I see people giving financials and then they don't normalize their earnings. And so what do I mean by that? So most businesses are sold as a multiple of EBITDA, earnings before interest, taxes, depreciation, and amortization. I'm sure your audience knows that. Now that's one definition. And then when you normalize, what you're trying to do is figure out what is the cash flow that the buyer is going to get come closing, right? And so is the buyer going to have to pay your club dues Is the buyer going to have to pay for Holly, who came into M&A, help you with your M&A? No. What about like you go to conferences all the time? So those are easy ones, right? Those are easy things to look back at your past 3 years and get your story. So you need to tell a financial story that is the absolute best picture. So that's the first thing you do. The other thing that really goes haywire is that small to medium sized businesses have bookkeeping and accounting that's really based for tax. So what happens is their accounting doesn't maximize their value. Let me give you an example. When a business is growing and they show me cash basis financial statements, if I'm on the buy side, I know I'm getting a deal because when you're growing, you show the least amount of money on your cash basis financial statements, meaning the least amount of earnings, the least amount of EBITDA. So you just took a haircut and you didn't even know it. Now, sophisticated buyers come in and they're like, okay, this is great. So because it helps them. Day one, they're millions of dollars more because they changed an accounting method. That's important. So, in a lot of businesses, there's accounting that most accountants don't know that are resourced at that level of companies. And generally accepted accounting principles, while very boring and we don't want to talk about it, it's really important for your CPA that's getting you ready, whoever's getting you ready to exit. So hire a professional if you don't have internal sources. It's really important for them to look at your business, understand your business, and use that tool to maximize your revenue. So that tool could be, listen, if you're expensing a bunch of things that you should put on your balance sheet. So, for example, if you are designing some AI that seems to be very, very popular right these days, right? Well, you can take some of those costs, including internal costs, salary costs, and such, and move them from your P&L to the balance sheet, amortize them, and they will never hit your EBITDA ever. We've just permanently improved your enterprise value, the value of your company, by millions of dollars by putting things in the right place. So there's all of those things that are about readiness. But if I can just take it one step further, so having leadership depth on your bench. So it's not a lifestyle business, not Holly running the day to day and doing everything, and everything just doesn't work after Holly leaves, right? So we you are priced higher. So when you look at companies in this space, there's always a multiple range that I will give a business. And it's like, let's say it's 6 to 8 is the range. Well, how do I get to 8 instead of being stuck at 6? Like, I want maximum multiple. Well, having a second leadership bench, having reoccurring revenue instead of just project-based revenue. Some companies you can't do that, but if you can, accounting firms are dealing with that right now. Like, get them on subscription based. That's the new language, right? You have a big concentration of revenue. Start changing that and making it less and less. All of these things help you. Even having systems in place, having a strategic plan in place, having processes and procedures, even having I don't know who goes into the corporate office anymore. People do. I have not, but people do. And having a beautiful corporate office and a brand presence, you will be paid for at a high end, getting that buyer to fall in love with you. So I said a lot of things here, but the bigger picture is that you as a seller want to curate your story before a buyer even comes in, or buyers come in, because you want buyers to come in, then you select who you want. So that's really important. That's what I don't see them doing, and that's what they need to do.
Yeah, yeah, great insight and great points there, Holly. You mentioned a couple of things. Obviously, the big thing in AI narrative is front and center for many people. Would you say that buyers are seeing that as an increase in multiple of evaluation of a company with AI infusion, or what are your thoughts on that?
Yeah, I mean, AI is huge. And yes, you will be more sexier with AI. So I have accounting firms right now that are looking to roll up and they're trying to deploy AI and innovation. So absolutely innovation. I mean, it is the thing. It is the bubble right now that we're all waiting for in the market, right? But
That's right.
deploying it so that you can be efficient in your business. So let me give you a statistic for all your business owners out there. I use the same rule that people that know Adam Coffey uses, and he's built many businesses and sold for $2.5 billion. And this is kind of a diagnostic for everybody. So your gross margin should be greater than 30%. Your SG&A, your OpEx expenses should be less than 20, and you need to be over 10% net income. If you're not, you're a turnaround company. So AI will help you come in and take some of this low value work instead of, I mean, I hate to say it, but you have to say it, instead of hiring people to do those things, you will have efficiency. You have to, even when I was growing companies, and that wasn't that long ago, you had to every year look at your operating expenses. As a CFO, I had to do that and figure out, how do I reduce these every year? And so, what are the initiatives around reducing it? Oftentimes, when it comes to OPEX, it's a lot of little things. So you think, oh, the supplies don't matter. And maybe they don't. But coupled with this and that and the other thing, over time, this adds up. And so, yes, AI is big. Yes, it can help you engineer. I don't see the small businesses taking that concerted effort of making sure you're not bloated in SG&A. And what happens is, as you scale, I mean, this is the thing. Like we talked about, only 7% of small businesses actually hurdle $1 million, right? So when you go from 0 to a million, that's a big point in time. Then a million to 5 million, then 10 million, then 50 million. People start throwing SG&A at the issue. And I think, Skylar, to your point, is I think that you have to start deploying AI and other things. And you really want to invest slowly on the SG&A and invest more in sales. I'd take the S out of the G&A then. So S is the sales portion. I'd invest heavily on sales and make sure you're growing your revenue profitably. If you're just growing your revenue, you could grow yourself out of business. I've seen that happen. So you want to make sure you're growing your margin, growing your EBITDA. Actually, nobody, I'm going to say this blanket statement, nobody cares about your revenue. That's kind of sort of false. However, we care more about your earnings growth year over year. You should care more about your earnings growth, because that tells you how much you can distribute to your pocket or invest in crypto or invest in other things with that money. So regardless, like we'll go back to the first thing I said, is like everybody should be exit ready, because you're thinking about the right things. Don't grow revenue just to grow revenue. It has to be growing revenue profitably so that it comes down to the bottom line. So you as a business owner have more money. And when you get ready to exit, you have that beautiful story that's a growth story.
Yeah, absolutely. Yeah, very, very interesting insights there, Holly. And I'm sure every small business owner is looking at this from a different lens too. I'm curious too. We talked about this briefly in our initial call, which we'll get into, and we'll kind of have a few questions about your book and how you kind of thought about that as you went into it as well. But getting into the aspects of lots of fraud in the M&A space and what you've seen, love to get your take on that.
Yeah, I mean, that was surprising. So, in my background as a CPA, I did get, I'm not going to say roped in. I was going to say roped into fraud. That is not accurate. I actually raised my hand and said, yeah, what's happening? Send me there. That sounds like fun. It's a good Scooby Doo mystery, right? And so
Right.
I sort of got, my teeth cut back then. And then, as I was a CFO and scaling companies, I was put in good internal controls. Even with good internal controls, I saw fraud where I was at. And so I don't want the small to medium-sized businesses to think that they're at prey, but they really are at prey. And so the stats there are somewhere between 30 to 57% of our small businesses have fraud. I mean, that's a lot of fraud. And so, Skylar, to your point, I'm putting together for these sellers this story of their financial statements, and it doesn't make sense. And why doesn't it make sense? What I am happening upon is fraud. And when we were initially talking about this episode today, I had just uncovered two back to back. And one I hadn't proved, but I'm sure it's true. And one it was proven. So it's a big deal. And if you're a business owner, if you think 50, and why we can't really hone in on the exact percent is that most of the times it goes unreported. So where do you get a stat from? You don't. You want them to get the heck out and not come back. I had one business owner that came to me and he's like, I want to go out to market. I have people knock on my door all the day, every day, trying to buy my business. And I said, okay, well, let's sit down. Let's sit down and take a look at your financial story. It didn't make any sense. And his daughter worked there, and then there was a controller. And I started digging in. Every month we'd meet, and nobody could answer my questions. Neither could the controller. And so the CEO told me, he goes, well, every time he goes on vacation, he takes a box of his records home. I'm like, what? Okay. And then he locks his office. I mean, listen, none of those things are good. So usually there's red flags on the field. He didn't suspect him of fraud, but we did not. And a lot of CEOs don't want to spend the time to find the fraud, right? Because they're good at it. They hide things on the balance sheet. Why do I say go to the balance sheet? One of the reasons is for fraud. They hide things in places and move things around. So it's like a shell game to find it. And so oftentimes they just want to move on. This CEO moved on. He got the high end of the multiple range. He sold. He's happy. He's on his earnout. All is well in his world. But yeah, so that's what I'm seeing right now. So if I was going to, and I have so many stories. So let me just tell you, first of all, whoever's out there listening, it's always the most trusted person. In 100% of the times, it was somebody that was a friend, a family friend. They befriend you. I had one that I was called, and this is a long time ago, but like she was like a grandma accountant. There was a high cash. It was a retail establishment, high cash grandma accountant, but every year she had a new Mercedes. Like, why? And so I don't know. So the first thing is if you trust them, that doesn't mean that there's no fraud happening. It will upset you to the core, but it's true. That's the first thing. And it happens small and it starts getting bigger. That's why when I say know your numbers, it's one of the first things I said when I got on here was like, you think you know your numbers, but do you? When I look at numbers, and again, as a CEO, I don't want to make anybody into accountant. I don't want your audience to be an accountant if they're not. I don't want you to spend more time than you need to on accounting. Go run the business, okay? But when you look at your P&L, look at trends. So I look month over month over month, because that's how you see, well, what's happening to my gross margin? Is it going up and down? What's happening in our world? And when I look at the balance sheet, if there are oddball things that are getting on there, that absolutely could be fraud, because it has to go somewhere. If cash is leaving right into my pocket, it's got to be somewhere. And in small businesses, you don't have internal control. So I said, even in big businesses, you have fraud. So you definitely have them, in small businesses where, the kid that has a lemonade stand actually gets the cash. He records the cash and then he reconciles the cash, right? Like, so all those things, all those controls are mixed up together. And so I don't want you reconciling either, but some purview. And then another way to prevent it is to have a culture of saying something that doesn't look right. In almost every case, there was an AP staff or there was somebody that kind of goes, I had somebody stealing petty cash once. I mean, that's a tiny one. That's probably the tiniest one I've seen in one of my companies, but somebody knew something and they told AP. People talk. So creating a culture where people come forward and say, I don't know, this looks a little weird, and we make that a normal thing, that's really important. Knowing your numbers is really important. And I think with those things, and looking at those controls, just make it a little harder so that cash isn't the person doing everything with the cash, so they can just kind of run away with it. And these days it's not checks anymore. It's digital payments, right? So you do what you can there and do your best and stay vigilant, and I don't want to say trust no one, but I should say trust no one. I trust people, but trust no one when it comes to that. I think you have to be vigilant. So
Yeah.
that's like a long way of talking about that, but yeah.
Yeah, it's definitely interesting. I wonder why it's always the trusted person in the
Yeah,
mix,
well,
right?
yeah, because they do it. It's manipulation. So I
Yeah.
had a in one of my companies, this is like, I had the CEO go, "Is that fraud?" Okay, so I'll tell you about it. Like, I had an IT director, and at the time I was like director level. I wasn't the CFO, and there was a CIO, Chief Information Officer, that he reported to, and we had a big budget because we were trying to upgrade our IT infrastructure. But all of a sudden, my he would come into my office and try to tell me too much. Like, I think I look at behavior things. That was too much details, and he would try to be friends with me, and I was like, yeah, I don't. I have a lot to do. So but he tried to do that. And then come to find out, my GL accountant who does the fixed assets, she came to me and she said, something's going on here. Like, we have more computers than humans. And I'm like, okay. And we have more, I don't know what we bought back then. Doesn't matter. Okay. But we had more things. Well, so I love a good mystery, right? And so we deployed all these tactics to figure out, because I wanted to go after him and get him fired. Because once they know, if they know, they will steal more. It's counterintuitive. It really is. I
Right.
don't get it. I would be scared. No, they do more. And so we found out he was getting kickbacks. So he was getting kickbacks from the the vendors. So he'd get extra TVs and equipment. And that's the CEO goes, "Is that stealing?" I'm like, "Yes. Okay, we could have gotten a discount or gotten the kickbacks for ourselves, if they were offering something more than just a dinner for all the
Yeah.
purchases," right? So
Right.
yes, so it happens. So I would say it happens more than not, and so for people to be vigilant, even if you're not trying to exit, it's a good idea.
Yeah, absolutely. Yeah, that's very, very interesting. Obviously, as a trusted advisor, you almost feel probably as a buyer or the business owner, kind of guilty, maybe to your point. They just want it to go away. Don't think about it.
Yeah, seem to be seeing it happen everywhere. Not only at companies, but throughout the country, and yeah, it's bad for sure. Holly, on a note, like in terms of today's market, can you talk to us about some of the businesses that maybe private equity companies are currently most interested in today?
Yeah, they really like businesses that are have reoccurring revenue, are fragmented. So there's a lot of businesses out there. So it gives a lot of new buyers a chance to get in the marketplace and buy the businesses, smaller businesses, build them up, and sell them the first exit point to private equity as like a platform company, a company that kind of kicks off a fund, is 4 million in EBITDA. So you, as a buyer, you want to find not project-based revenue, although those sell too. So I don't want to say that, but like, what's the sweet spot? Home services, roofing, electrical engineers, home services. The law firms are now, because it used to be that law firms, you had to be a lawyer to buy them. That's changed. That's changing. And so they're becoming hot right now. That's the hot up and comer. Accounting firms. I mean, there's so many accounting firms. I can't give you any stats on that, but there's so many fragmented firms, and they used to only be able to sell to CPAs. That's not the case anymore. Audits get carved off and stay with the CPA, and private equity comes in and gets the reoccurring tax, bookkeeping. They're great cash flow companies. So anything that cash flows well in the marketplace is important for private equity right now. And I think there's like $4 trillion. There's so much money out there waiting to be deployed. And so that's how you become more attractive. It doesn't mean if you're under 4 million of EBITDA, you don't get purchased by private equity, but the bigger you are, the higher multiple you get. And so, and that's where that arbitrage is for new buyers. They come in, buy a CPA firm, or let's call it accounting tax firm for a 3, maybe a 3.5 times their earnings. And then you put a few together, you get 4 million EBITDA, you're, I don't know, 6 to 8 to 9 times. The price has gone up since in the past year or so, the multiples have gone up for CPA firms. So as a buyer, you buy at 3.5 and you sell at 8. Those are huge numbers there. So if you are smaller and you want to sell to private equity, they will come in, they will buy you. I had one that sold at 3 million EBITDA, and he got a high range of the multiple, but he had all those levers we talked about, the systems, the leadership, all the things we talked about. He sold high. He was not the platform company. So one of the things I'll say about the going into private equity is they usually want you to roll over some equity and invest some of your money in their new company. And so if you're rolling over and you're the platform company, you're the first company, and then they're going to sell from 3 to 5 years, they're going to get that platform with a bunch of others and sell at the next level, 10 million or whatever it ends up being. And you will get a bigger price the second sale than you did the first sale. So we always call that the second bite of the apple. So the second bite of the apple is actually more delicious than the first bite of the apple, which is your sale. Now, you usually get that equity regardless of whether you get fired or not. It's hard to stay employed at private equity because you have to grow the company 30%. You have huge stats to actually achieve when you sell. So if you come in at less than 4 million EBITDA, you definitely can do that. You're just not the platform company. You're a bolt-on, so they add them on, and then you still get a second bite of the apple, which is still delicious and still good. But you're not the first one, and you're less in charge. So depending on who you are and how you want your legacy, how old you are, all those things determine what that looks like. So yeah, so in the marketplace, all those things are hot right now.
That's interesting.
But there's so much money. I think you can sell anything. I've had contractors which are project based. They've sold to private equity. So I don't want to say that you're not desirable if you're not. I'm just saying those are the most desirable.
Yeah, absolutely. That's great. And by the way, just the title of your book is, I'll just read it off here: Finding the Missing Millions in M&A, How to Maximize Value and Minimize Regret in Every Transaction. Great title, by the way. That's a great headline.
Thank you.
Amazing.
Thank you. Yeah. It's funny because when I wrote the book, I called it like, it's just this little M&A field guide. Like I want it to be on everybody's desk so they can refer to it. And my publisher was like, this isn't an M&A field guide. And so she helped me come up with it. Publishing is a wonderful thing. I should never self-publish. And once she came up with that title, I was like, I got to make sure that it delivers. Like, I better go back through. So my editing process took longer than the writing process because I went back and I said, well, let me overtly point out what's happening here and make sure I'm delivering the millions and less regret. So that process was a really interesting, challenging process, but having a publisher helped, 100% help get that story to where it should be. So thank you for that. I will tell her. Yeah. She will love that.
As far as, people going to you for advice outside of you, of course, which we can, people on the show here, they're listening in. If you have questions, reach out to Holly. But as far as if someone's looking to get information, where should they go outside of AI or books or, things that they read about? Where are kind of your recommended resources there?
think the start is podcast and reading. I do think like educating yourself, and then the second part is having hiring people to help you in the areas where you think are weak. So after you know the terrain, hiring people to help you. Like for example, your accounting. Okay, well let's make sure you're doing proper accounting, or you're maximizing your value through accounting. Make sure that that happens. But one of the things that I can say is if you are going on the adventure of M&A, either from the sell side or the buy side, you definitely want somebody on your side. So the one gentleman that he sold to private equity, we would be in a room of 9 accountants, tax and auditors. That's scary for a CEO to do that. And there's provisions in the buy sell agreement, like on working capital. Nobody understands this. And so you better take and that happens later, either after diligence or at the asset purchase agreement level. You better, as a seller, be thinking about that in the very beginning, because sellers and brokers of sellers for small to mid market seem to think they get to take AR, they get to take everything. Sophisticated buyers are going to ask you to leave it. So that means you're not going to get your right price. So that's just an example of saying, boy, you better look out to the terrain and make sure you understand at least where the pitfalls are, and back it up before a letter of intent, and figure that out beforehand. So I don't know if I answered your question, but I really wanted to say that about the whole terrain, that just by understanding that and bringing somebody in to help you will save you millions of dollars. I had my one client say, and this was working capital, it was the night before closing, and we had asked for a meeting to figure out, should we be billing all this work that we have done? And they said no. And I said, okay, so then you're going to give us credit for it. It was $1 million worth of work, $1 million. And they said, no, we're actually not going to give you credit. That's not what it says in the agreement. Well, we were literally 4 p.m. and we were closing at 9 a.m. the next day. And I looked at the owner and I said, okay, well then we're going to bill all night, or we're going to postpone closing. Because if we bill all night, then it got included in our working capital calculation. And my CEO is sitting there going, I didn't know that they were screwing me out of $1 million. You don't know. And so don't be in the room with people that have been there and done that, because M&A, you've done one or two, you're still not an expert. You figure out things every single time. You don't want to be in a room where they've done it all the time. I can guarantee you will be screwed in some way. I can guarantee it.
Right.
So bring somebody in. So learn from podcasts, learn from books, and then just discreetly hire somebody to help you, because again, that will never go against your earnings. You can add that back, right? And it should give you 10 times, 20 times. It should give you an ROI that you could absolutely measure.
Yeah, definitely well said. And obviously there's a lot of nuances, what you mentioned earlier, not having your family member be the accountant in the firm, right? It's probably a bad idea.
But I see it all the time. I see it all
Yeah.
the time. Yeah.
Yeah. Yeah. Getting back to kind of some of the businesses we talked about, what about let's maybe go into the structuring of the deals. What does it look like? The earnouts, the debt, skin in the game, as you mentioned, a lot of buyers like to see that from sellers. Give us a highlight of that.
Yeah. Typically what I'm seeing, so there's always trends in the marketplace depending on the desire, right? But the trend right now is rolling over equity. I see that a lot. It's not in all cases, but I see that they want you to have some skin in the game and they want you to stay and have an earnout. So it's going to look like, oftentimes I'm seeing, there's a big cash down payment. It's not 100% cash. It's 60, 70%, something like that, cash down. There's a seller note that's very in vogue right now, to have a seller note. So have you, as a seller, finance some of the buyer. That's in vogue. And then an earnout. And let me just talk a second about earnouts, because people hate earnouts, and I understand why. I love them. So why? Okay. And I love them not only for sellers, but I love them for buyers. As a buyer, I 100% did earnouts. But there has to be some, I call it the three C's, the control, cadence, and clarity. And so clarity means buyers write terrible earnouts. Okay. And so there's no clarity. And then people are angry. And then you screwed me out of millions of dollars, right? On both sides. So, and that clarity is I had one that said net revenue. Okay. That's an easy one, right? That one is easy to give the person control. So that's the other thing, is you want to make sure whoever's got the earnout has control to deliver. Right. And so net revenue, that's simple, right? And it said net of bad debts, according to GAAP. Easy. And so I painstakingly said, well, that's the greatest thing I've ever seen. And the CEO at the time, he said, do we really care about this? And I said, oh, I think we care about it. I wrote a definition a mile long. And you're going to go, okay, she's crazy. And I'm going to say, well, I'm going to tell you how uncrazy I am. And so GAAP for bad debts could be anything. It's gray area. So anybody that knows GAAP knows you can have aggressive, conservative. There's a range, right? And so I wrote a sentence in there that said, I was not going to give in on this. I said something like, if they're still trying to collect and they still believe it's collectible, then it's not considered bad debt. So 4 months after closing, I get a call from my CEO, who's now with private equity. He said, all the accountants have changed our bad debt. Okay. And they made anything over 90 days is 50% bad debt. And they deal with insurance. And we all know when you deal with insurance, that adds some additional time to the payment cycle, right? And I said, well, you don't care. Okay. You don't care because you have it written, you don't adhere to that. And I said, actually, I like the accountants. The accountants are doing the right thing. But it would be go against you as an earnout. And so when I go to the third C, which is cadence, I'm saying that in this case, you shouldn't wait till the end of the earnout to find out whether you're on earnout. You should have cadence. And when something comes up, so what we did was we cut and pasted this beautiful paragraph that me and his attorney crafted. And we sent that over and said, hey, we understand the accountants are changing things. We don't think it applies to our earnout. Are we in agreement? And therefore it gets in writing. And they said, yes, you're right. And so, but if it was silent and just said in accordance with GAAP, we would have had a fight on our hands. And so I just think you wouldn't know this. Who knows this? When you sell your business once, nobody does. They just don't. You can't be held accountable for knowing these things. So anyway, so again, don't go it alone. So yes, so you'll have an earnout. You may have a seller note. You might have rollover equity. All of that looks really good. Maybe cash should be above that 60 to 70%, particularly if your earnings, if you have a growth story or you want more money, that earnout bridges the gap between what you think it's of value and what they think is of value. So that's what I'm seeing. And on the buyer's side, I have buyers that write earnouts that don't match their goals, their North Star. So I had an earnout of a new buyer that she wrote, well, yes, you can lose 10% of your customers and still get the earnout. I'm like, okay, well, let's pencil that out. Okay, that actually doesn't work. And she had a goal to grow the company. So you have to, and private equity does this. They don't let you stay static for 2 years. Of course, they want you to retain clients, but they want you to grow it. And so they're going to pay you and they're going to pay you a higher multiple. They might park some of it in an earnout, a percentage, but that varies based on deal by deal. But that's kind of what you could look forward to. And the seller notes, one thing on the seller notes is what I'm seeing a lot, particularly when you have a higher multiple, it's harder to get debt. And so I'm seeing a lot of buyers ask for interest to be accrued, but to be deferred and not paid. Because as a buyer, when you buy a company, even if you get working capital delivered, it never seems to be enough. And there's things that happen. So deferring cash out of your pocket as a buyer is the most important thing you can do. So if they'll allow you to take a seller note and accrue the interest and pay it later, that's better for you and helps with your bank debt and to be able to cover that debt. So I think we go wrong as a buyer getting a debt coverage ratio of 1.25. They will allow it, but that means you have $1 for debt and only 25 cents for giving you money, and oopsies, and anything that happens, which is not enough. I like it closer to 2. So that's harder to do if you're paying principal and interest on a seller note and you're paying a market multiple for a good company. That's tough to do. So navigating that as a buyer, figuring out what you can afford, and don't get yourself knowing how much working capital you have, what can you afford, looking at that debt structure before you rush into an LOI. That's what I see, people rushing into an LOI because we get excited, but the LOI is non-binding, but people like start buying things at the LOI level. People start wanting to, those are starting to be commitments, even though they're non-binding commitments, and trust is being garnered at this point in time and developed. And so you really don't want to rush in. None of the sophisticated buyers or private equity rush in. They will do their best to find out as much. They will rush in if you make them, but they'll do their best to find out as much as they can about you before they come in and start promising rose gardens or whatever they're promising.
Right.
100%.
Absolutely.
And these stories are great, Holly, because a lot of these stories are, they're very real examples where it's just things that, somebody that's never, like you said, most people will, if lucky, sell a business once. And these are things you'll never think about. It'll never cross your mind. So these examples are great. Final question I want to tee up with, are buyers today, are they smarter or are they better capitalized, as compared to the past?
I think they're smarter. I think they're smarter, and there's a lot of money in the marketplace. So if I can just go back, I was doing a lot of my own personal buying for a company, even through 2020. I think that was the last purchase I did as a company, and I would go to head, and I've been doing it for 10, 15 years at that time. I'd go into a situation where we're all vying for a market sim comes out, a market flyer, and we all get on the bandwagon as buyers. And I used to come into that space and see private equity every once in a while. And then when it got towards 2020, it was more like 50% of the time. So I had to get my arsenal of why private equity is so bad and you want me, because that was part of what we were doing. And so now private equity is there all the time. So, private equity has been growing. I don't know the graph, but it's definitely going up. So there's a lot of money out there. There's a lot of people talking about it. So people are getting more educated. And sellers, I think, actually need to catch up. That's what I see in our marketplace. They need to catch up and figure out how to maximize their revenues. That's kind of what I'm saying. Did I answer your question, Mike?
Yeah, absolutely. I think that makes total sense. It's a lot's changing, but like to your point, these guys are getting smarter, or guys and gals are getting smarter, and also there's a lot of capital. There's a lot, a lot of capital, which is pushing a lot of big brains into this industry.
Yeah, exactly. Yep.
Awesome. Well, Holly, we're coming up on time. This has been a lot of fun. We really appreciate you joining us and sharing your insights here on M&A. Where could people go to connect with you, learn more about you, and also give a plug to the book one more time as well?
Okay, it's Finding the Missing Millions in M&A, and that's on Amazon. That's everywhere. You can find me on LinkedIn under Holli Moeini. And there's a bunch of eyes in there, and at my website, hollimoeini.com. So please reach out. Any questions, any comments, I'm happy to help. And I'm very grateful to be on your podcast today. Thank you for having me amongst all of your wonderful guests. I appreciate you both getting this information out into the world. Thank you.
Yeah, well, this has been amazing, Holly. Thanks for joining us, and appreciate the conversation. And we'll make sure to include all your info in the show notes as well.